There's a 52-year-old guy somewhere in Ohio right now. He makes $94,000 a year. He drives a 2017 Toyota Camry with 130,000 miles on it because, in his words, it still runs. He has a $400 set of golf clubs in the garage he's used twice. He has $9,800 in credit card debt he's been carrying for 3 years. He also maxes out his 401k every year without fail. He doesn't trust the stock market, but he's in it. He doesn't trust his employer, but he's been there 11 years. He's paying his mom's prescription copays and his daughter's car insurance. Ask him how he's doing financially. He'll squint and say, fine, in a way that does not mean fine. That guy is the entire Gen X economy. We get into the math. Let me explain why Gen X is genuinely, structurally, measurably different from every other living generation when it comes to money. Because this isn't a personality quirk. This isn't a vibe. This is what happens when you take a group of human beings, drop them into the worst possible economic conditions at the worst possible ages, and then ask them to fund their own retirement using a system that was invented as a tax loophole. There are roughly 65 million Gen Xers in America today, born between 1965 and 1980, currently aged 46 to 61. That's almost exactly the same population as the boomers, and yet boomers control about 51% of all household wealth in the United States, while Gen X controls 26%. Same population, half the wealth, $83 trillion versus $42 trillion. If wealth were distributed by population size, Gen X would have an extra $20 trillion sitting in their accounts. They don't. That missing $20 trillion is not in their 401ks. It is not in their home equity. It is not in their savings accounts. It is somewhere else, owned by someone else, and we're going to spend the next 18 minutes figuring out where it went. Let me start with the childhoods, because everything traces back here. Gen X was the first generation in modern American history to be raised on a mass scale, without parents around. The U.S. divorce rate doubled between 1960 and 1980. Married couples with children dropped from 40% of households in 1970 to 25% by 1990. Women entered the workforce in record numbers, but the cultural infrastructure to support working parents didn't exist yet. Daycare wasn't normalized. After-school programs were rare, so the kids came home from school, let themselves into an empty house with a key on a string around their neck, made themselves a snack, watched MTV, and figured it out. According to a widely cited 2004 study, around 40% of Gen Xers were latchkey kids. 40% of an entire generation raised themselves between 3 p.m. and 6 p.m. Monday through Friday for most of their childhoods. And here's why that matters financially. When you're 7 and your parents aren't there to fix things, you learn to fix things. When you're 10 and the toilet's overflowing, you don't call anyone because no one is coming. You grab a plunger. That's not a parenting failure, by the way. A lot of Gen X parents were doing the best they could in a culture that hadn't caught up to dual income households. But what it produced was a generation that, by adulthood, had internalized one specific lesson. The system isn't going to help you, the adults aren't paying attention, so you'd better figure it out yourself. That single belief is the foundation of every weird financial habit Gen X has. It's the latchkey kid grown up, still convinced no one's coming to rescue them because, historically speaking, no one ever did. Okay, so the childhood programmed the operating system. Now let me tell you a story, because the rest of this video is going to make a lot more sense if you can see it through one person's life. So picture a Gen Xer. Call him Edward. Edward was born in 1968. His parents got divorced when he was 11, which was a pretty normal age to have that happen back then. He graduated high school in 1986, did 2 years of community college because his parents said a 4-year degree was a luxury they couldn't afford, and started his first real job in 1988 at a regional bank making $19,000. They handed him a benefits packet and said sign up for this thing called a 401k, and Edward, who had no idea what a 401k was, signed up. He put in 3% because that's what the HR lady recommended. By 1995, Edward was 27, making $34,000 with $11,000 in his 401k. He felt rich. He bought one share of Microsoft. By 1999, he had $87,000 because the dot-com run was inflating everything. He bought a small townhouse in 2000 for $148,000. He felt like he was on his way. Then the dot-com bubble popped. His 401k dropped from $87,000 to $44,000 in 18 months. Cut in half. He kept working, he kept contributing. By 2006, he had clawed his way back to $156,000. He upgraded to a real house in 2006.